Good afternoon, and thank you for joining us today. Hope you all are having a great week so far. Today's presentation is on ensuring sales tax compliance in 2024. Your presenters today are Tax Connect partners Jeff Meggs and Brian Greer. Just a few housekeeping items before we get started. All your lines are on mute and will remain on mute throughout the webinar. Just as a reminder, this webinar is not eligible for CPE credit. We are providing a copy of the slides, which can be found in the handout section of the GoToWebinar panel, and a recording will be emailed out tomorrow. If you have any questions for us, please submit them within the questions box on the GoToWebinar panel, and we'll answer those as we go along. We'll do our best to get to all the questions, but if there's anything that should be answered in private or we can't get to them all, we'll respond to those afterwards via email. Again, thank you for joining us, and with that, I'll pass it over to Brian.
All right, thank you, Kate. Appreciate the introduction. Before we got started here, we were just talking amongst ourselves about how darn cold it is where we are. I'm not sure what it's like where you guys are. We complain when it gets below about 40 degrees. So I know some of you are probably experiencing much worse than that. But we're in the Atlanta area, so we're excited. It's going to be about 45 today. But I think it's going to get down into the 20s again in a couple of days. So at any rate, thank you for joining us today. If you've not been on one of our presentations before, I'll give you just a little bit of perspective on our business. Tax Connect is focused in the sales and use tax area, and we really have two different lines of business here. One of those is our consulting group, which is led by Jeff here with me today. And in that area of the business, we really deal with a lot of questions related to nexus, taxability questions, excuse me, maybe sales tax audits, voluntary disclosures, that type of activity. They seem to be, project-oriented type of work with a definitive beginning and end. And then the other aspect of our business is a compliance outsourcing service where we become an outsourced sales tax department for our clients, where we prepare and file returns and remit payments and really just kind of manage that ongoing compliance process for our clients. So I'll hit the agenda here real quick before I turn it over to Jeff. What we often like to discuss and talk about first is nexus, because it really is the basis for all things sales tax. So we'll start out with a nexus discussion, as well as kind of segue into taxability and the variation from state to state. Look at some opportunities or options for identifying your sales tax exposure, and really at that point talking about how do we get into compliance overall in terms of putting in some type of a sales tax calculation process, registering with the jurisdictions, and then that ongoing filing and remittance process as well. We'll wrap up with a few kind of things to think about for 2024 and updates that you might want to make sure that you're taking advantage of, or at least implementing within your sales tax process. So, Jeff, I'll go ahead and turn it over here to you for the Nexus piece here.
Thanks, Brian, and thanks for everybody joining us here in the middle of winter, it feels like. As Brian said, it's been a little nippy here for the last couple of days. As Brian said, the starting point, launch point for a sales tax discussion really should have a nexus aspect to it. The premise being that if you don't have nexus, you don't have an obligation to comply for sales and use tax purposes in that jurisdiction. So what does nexus mean? Nexus is just a term that equates to a connection. If you have nexus, and this can be used, nexus is used in a lot of different aspects, but for sales and use tax purposes, it's a connection with the state that obliges you to comply with the sales and use tax laws of that state. And historically, nexus was defined in a physical context, meaning if you had a physical presence in any shape, way, shape, or form in the state, you could have nexus for sales and use tax purposes. And once you have nexus, you then determine whether or not you're obligated to be registered and obligated to maybe charge or self-accrue and remit sales or use tax on your business activities. So what is physical nexus? What is a physical presence? What was represented by that? And this is somewhat case law that goes all the way back to 1967. That there were a number of cases, or a few landmark cases, I'll say. One in 1967 with the state of Illinois against National Bellis Hess, and then fast forward to 1991, another one between North Dakota and Quill. And essentially, what was established in those cases was the activities that involve having an office in the state, having a full-time employee resident in the state, having inventory in the state, maybe owning equipment that's being leased to customers in the state. That would be a form of inventory. Those were sort of standard and fixed sort of scenarios that established a physical presence. But there were things beyond that, and there were things that reflected a temporary presence, meaning I may have a sales rep visit the state for a few days each year to solicit on my behalf. I may have attended trade shows during the course of a year, and at those trade shows, I'm probably marketing my products and services. So there's other things, and maybe I'm leveraging some internal resources within that state to deliver a service to my customer. And that might be something that looks like a repairman that is obligated through my actions to visit a local shop in that repairman state and perform a service that I'm going to bill for. So even though I don't make any effort to be physically in the state, some of those activities could trigger a physical nexus and a requirement to comply. That being sort of the standard or the baseline for a good 50 years or so, we had a major change in the arena of nexus back in 2018, which to us still seems like relatively recent, but now that it's almost 6 years ago, it's getting to be old news. But in any case, there was sort of a turn of events that kind of shook the world of sales tax nexus pretty significantly. And that was when South Dakota enacted a formal legislation that dictated an economic presence would also trigger nexus. And in their statute that they legislated, an economic nexus was defined as $100,000 in gross receipts during a calendar year or 12-month period, or 200 or more transactions within a 12-month period. Either of those scenarios, the state would deem you to have established nexus, and you would then be obligated to comply with the sales and use tax laws of the state. This was, while it was sort of relatively new in the terms of this level of assertion of nexus, there were other states that had sort of tested the waters around economic nexus prior to this, and there were other types of nexus strategies that states were employing, such as click-through nexus, things that weren't necessarily they were technology-driven in a lot of ways. But this particular case made headway, and ultimately, once they asserted nexus against Wayfair, who's a very large marketplace retailer, Wayfair fought the assertion, and it went up through the South Dakota courts, and ultimately landed at the South Dakota Supreme Court. And at that point, the Supreme Court ruled in favor of Wayfair, striking down the constitutionality of this economic nexus law in South Dakota. So South Dakota then took this up to the U.S. Supreme Court, and in April 2018, the Supreme Court decided to hear the case and to hear the arguments, and ruled favorably in favor of the state of South Dakota, thus opening the floodgates for any and every state to enact their own legislation associated with economic nexus. And that's exactly what happened. It didn't all happen on day one. You know, this decision, I think, came out in the middle of June of 2018. There were definitely states that had already prepared themselves for what they deemed or considered a win at the Supreme Court level, so they really quickly enacted their own legislation. But then there was sort of a staging of states, and that led up all the way through to January 1 of 2023, when the last state, Missouri, enacted their legislation for economic nexus. So today, all states that impose a sales tax have an economic nexus standard. And when we say all states that have a sales tax, some of you, or maybe most of you, will know that there are 5 states that do not have a state-level sales tax, those being Alaska, Oregon, Montana, New Hampshire, and Delaware. However, the state of Alaska is unique in that there are cities within Alaska that have their own sales tax administrative legislation. So they have their own, we call them home rule cities. They have their own sales tax administration and laws. And in fact, those cities within Alaska got together and formed their own coalition to establish an economic nexus standard. And that economic nexus standard reads very similar to a lot of other states. If you have $100,000 or more in gross receipts within the state of Alaska, you have established nexus for sales tax purposes in each and every one of those home rule cities that are part of that coalition. I think there's still a few cities that are not participants in that coalition today, but the vast majority are. And it, I guess, is worth noting that D.C., District of Columbia, is in and of itself another sales tax district or a sales tax jurisdiction. So we kind of treat D.C. as a state, and they too have an economic nexus standard. So what does that mean practically to everyone out there that's kind of trying to run a business and grow a business? And the way I describe it to everyone is I would ask people to focus on that $100,000 threshold and think about your business activities in a 12-month cycle based on that $100,000 threshold. And when you hit that threshold, it's at that point that you might ask the question, have I triggered economic nexus? And the reason I use that 100,000 is that's the number most of the states use. But the reason I say it's time to ask the question, did I establish economic nexus, is because not all states are equal. There are states that have a $250,000 threshold, Alabama, Mississippi. There are states that have a $500,000 threshold, Texas, California. And New York also has a $500,000 threshold, but you also have to have at least 100 transactions that accompany that. So there's a variety of other attributes associated with these states and their economic nexus laws, such as one state might be a gross receipts, another state might be retail sales or taxable sales or sales of tangible personal property. So there's variety out there. I don't intend to cover the variety on the call today. It's just to say using that $100,000 threshold is a safe bet to at least start thinking about whether or not you've triggered or met that nexus threshold. As I described South Dakota's law earlier, I also mentioned the 200 transactions, and I also mentioned it with New York. There are a number of states that enacted this 200 transaction threshold, and there still are states that have that threshold. Interestingly enough, South Dakota has since repealed that aspect of their economic nexus law, so it's only the $100,000. The 200 transaction threshold, it's real. It will apply to your business, but I think the $100,000 is more meaningful in that it represents a bright line test from a materiality perspective. How worried am I going to be if I have 200 transactions but only $20,000 in revenue in the state? Do I want to invest in trying to make sure I'm compliant at that level? Well, knowing that the cost of compliance is a factor and may offset the risk associated with non-compliance. I say all that, but I do want to emphasize we are pro-compliance. Obviously, we're a business that's predicated on people being compliant, so that's one piece of it. But the reality is this is a relatively voluntary compliance aspect. I mean, the states are not equipped to mandate with force to every single company that exists that they comply, that they register. So the states are reliant upon us all as taxpayers to do our part to be ready and able and willing to comply with the sales and use tax laws. But again, it does come at a cost, and there's a point at which there's a cost of diminishing returns, and the decision has to be a business one. And it's also important to note that while you may have nexus today, while you may have some risk and exposure today, if you choose to do nothing, that doesn't mean that risk goes away. It stays in perpetuity. It never really expires. So if you envision a scenario where you've created economic nexus in a state year over year over year over year, and you've decided that 1 year it just didn't make sense materiality-wise to comply, you have to consider that in the aggregate, all those years that you had nexus are now part of your risk quotient. So it's just something to think about, something to consider as you do your business planning.
So Jeff, I'll give you a little bit of a break here, and Jeff and I are both struggling with some cold, so I'm going to give him a chance here to take a sip of water, but also to kind of segue and talk about the South Dakota scenario of repealing the 200 transactions. It is an update that we have a little bit later on in the presentation, but since we're talking about it, I'll go ahead and share it with you that there have been quite a few states since they enacted economic nexus where they've either changed or repealed those transaction thresholds. And the list of states include California, Colorado, Iowa, Louisiana, Maine, Massachusetts, North Dakota, South Dakota, which we mentioned, Washington, and Wisconsin. So it is a trend that we do expect to see more of that in 2024. But you can see there's been a little bit of a movement away from that and more of a focus, as Jeff was describing, on the total revenue rather than the transaction volume.
Thanks. I actually was surprised there were that many states that had kind of gone back on it. So interesting. So nexus is, again, that sort of first step, the first question in the equation of how do I determine what I need to do from a sales and use tax perspective. And once the answer to that question is yes, I do have nexus in that state or local jurisdiction, then we migrate to the next piece of the equation. The next question becomes taxability. Are my products or services taxable? And to put that in perspective, I'll just use our company as an example. We're based here in Georgia. We are a professional services firm to a large extent, providing what we would characterize as accounting services. And our services are not referenced in the statutes as a taxable event. They're excluded from the tax law. And so we characterize ourselves as excluded from sales tax. A lot of us just use the term, we're exempt from sales tax. They kind of end up meaning the same thing in the end of the day. So despite the fact that we're based here in the Atlanta, Georgia area and clearly have nexus through our presence, we don't have necessarily an obligation to register for sales and use tax purposes relative to our revenue. It's not a taxable event, not a taxable service in the state of Georgia. So we're not at risk here by not being registered and not complying, because there's no transaction that falls within the statutory code of a taxable transaction. When you look at the states, and I already noted that there's 5 states that don't have a sales tax, but when you look at all the states collectively, they all have a similar basis for sales and use tax application, and that is tangible personal property. So the standard language you will find in these statutes is the sale or use of tangible personal property within the state is subject to sales or use tax. Then you start to evolve into services, and this is where there's a vast array of differences amongst the states. Some of them being a little more heavy to tax services, some of them not taxing hardly any services at all. So generally, as I just described our services here in Georgia, we would say that those services are excluded from tax. And so the way you see the statutes written is the sale of tangible personal property and enumerated services are subject to sales tax. Enumerated means basically listed. So these statutes now have to list and specifically state which services they intend to tax. And in the absence of that specificity, the service would not be taxable. So this kind of rolls into things like telecommunication services, which are generally taxable throughout the states. It applies to things like software as a service, consulting services. There's a vast array of services that a lot of you on this call probably are engaged in that potentially could be taxable in any given state. Now, as I said, the states vary quite widely in terms of what services they tax. You can see a state like Hawaii that taxes virtually every service. A state like New Mexico does the same thing. And then you get to a state like Georgia, our state, not a lot of services are taxable in Georgia. Services can be things like installation services, services that are associated with or kind of accompany the sale of tangible personal property are more likely to be that lightning rod that the state legislatures will look to pull into the taxable base. The last part about taxability is situsing. It's important to understand that the situsing, and when I say situsing, I'm talking about where does the tax apply? Where is the taxable event deemed to have occurred? And in what jurisdiction does the tax get calculated? What rate applies? What jurisdiction do you report it to? And situsing is usually not very challenging when you're talking about transfers of tangible personal property. Usually we're the mass majority of us as consumers, when we buy something online, those products are typically shipped FOB destination. They're common carrier shipments that arrive at our front door, and our front doorstep is deemed to be the situsing for sales tax purposes. So when everybody on the call is ordering from Amazon, generally speaking, the sales tax is going to be imposed at your address, whatever that rate and that jurisdiction is. When you get into services, it gets a little bit challenging. It can be challenging from the standpoint that I could be performing the service at my home office in South Dakota, and you could be receiving the benefit of my service in your office in North Dakota. Where's the situs of that transaction? Where the service was performed or where the benefit of the service was received? And the short answer to that question is generally it's where the benefit of the service is received. And then you get into scenarios like SaaS licenses, software as a service licenses. These are software licenses that are subscription model based that afford me sometimes hundreds of what we call seat licenses. And that means hundreds of employees have the ability to log in and access a server at some point located in the country through the internet and leverage the power of that software at their laptop. In those scenarios, it's not uncommon for the service provider, the SaaS provider, to actually have a single line item on their invoice that says 200 seat licenses at $100 each per month. Do the math. There's a single line charge for $20,000, let's say. And the question becomes, where do we situs the sales tax? First question you have to ask is, where do we have nexus? Second question you have to ask is, where is SaaS taxable? And then you get into the complexity of this service offering that might span 20 or more states because these employees may be spread out and remote in various states. You might be billing the headquarters of the company in New York City, and they're a nationwide company, and they're using these things all over the country. It gets a little complicated. When you look at the statutory provisions, what we would expect is that we would leverage the knowledge of where each and every one of those seats were located and apply the tax rules and nexus rules accordingly. Well, that, as you might imagine, is a formidable task, and vendors generally do not want to have to manage to that degree of specificity. But you can use those rules to your advantage, particularly under audit. And either the vendor or the customer can use those rules to their advantage under audit. So there's a number of scenarios that can play out, and the message and I'll leave you with is it can get a little complicated, but there are some standardizations that I typically recommend. One of which, I'll only talk about one of which, is when you bill, use the bill to address and apply the tax as it should apply to the bill to address of that customer. Typically, we don't see a ship to address for SaaS invoices. We only see a bill to address. So if that's the only address that's on there, it's probably the safest thing to just apply the rules to that state. So if you have nexus there and it's a taxable state, you should charge sales tax. If you have nexus there and it's an exempt state or a state that doesn't tax SaaS, you wouldn't charge sales tax on that transaction. Where it gets complicated is when that customer starts to reveal to you where the users are located and starts to provide you with a level of detail that would afford you the ability to apply the tax more appropriately based on the benefit of use. That gets very complicated, very challenging, sometimes impossible to manage with tax calculation engines. But it all goes in hand. You've got the nexus piece of the equation, you've got the taxability piece of the equation, and finally the situsing. Where is the transaction deemed to have occurred for sales tax applicability?
And Tabitha had a question, and I don't know if we fully addressed it there in terms of the situsing. I think she was alluding to the situsing of SaaS transactions. So if you had a more specific question, let us know, or we might be able to follow up with you separately as well. There's another question here, Jeff, from Micah, and I'm not sure exactly where this goes, but it sounds like it might be alluding to kind of an information service, but just talking about service providers that provide some type of client portal where a customer logs in to either view or interact with content. I go to the place of information service. Can you maybe talk about what that is versus what SaaS is?
Yeah, it's an interesting question. Brian and I play in this sandbox quite a bit with a lot of companies we talk to. There is a distinction between an information service and a software as a service. The way I describe or define the distinction is if you're leveraging the computing capability or the computing power of an application through the web or a cloud-based action, that resembles what I believe to be a software as a service subscription, meaning it's not static data that I'm accessing. It is computational ability, and that computational ability can be both complexity as well as power. And when I say power, I just mean volume of records and volume of transactions that can be processed at a given time. Information services are more of a static database of data that I'm accessing, and there still may be some querying capabilities within that structure such that I can go in and say, I want everything that starts with an A, that in terms of phone numbers of companies that start with an A in the state of North Carolina. That starts to feel more like an information service. It's a static database of data, generally speaking, that I'm able to access and retrieve in a specific format. The taxability of SaaS and the taxability of information service, those vary by state. So it's critical that you understand whether or not your service fits into one category or another. Something else that was interesting in what Brian was asking was, I think you're accessing the data on a specific server. Sometimes the location of that server where that data resides, whether it's SaaS or whether it's information service, could change or dictate the tax treatment. So, for example, I may be in Florida, and if I'm accessing a database that is on a server in Utah, it may be exempt. And if that same transaction is accessing from a database or server in Orlando, it may turn into a taxable transaction. So form of transactions in sales tax really matters. It matters in a lot of different ways. That's just a really arbitrary example, but hopefully that answered the question there. So the other piece of this equation, now that we've talked about nexus, hopefully we have a basic understanding of nexus. We talk about taxability, and we presume that we have nexus, we presume we have a taxable product or service. What do we do about the past? What do we do when we're sitting at our desk and come to this realization and we have that oh crap moment? I was on a call with a client earlier today that was in that specific scenario. We talk to companies probably every day in that specific scenario, by the way. So you're not alone, first of all. And the states realize that those things exist. So there are a few options to try to go back in time and mitigate these exposures. The most common option that people land on is to just get registered and start complying prospectively. This is true for companies that if you don't have cash sitting around, if you haven't charged or collected tax in the past, and you just don't know where to go or what to do, this is not the most unsafe option. In fact, it's the most common option. And it just gets you into voluntary compliance. You start to charge tax on your invoices, you start to collect it, you start to remit it, and you move forward. It does not mean you're absolved of your risk in the prior periods. Those will remain with you. So maybe you book an accrual so that at least from a financial perspective, in the event something does happen and in one of those states that you've got this exposure, they come in and audit you and go back in time and assess you, you've at least got some financial recordings to offset that. It's still a cash hit that nobody wants to experience. Another option that's not as popular, and frankly we discourage whenever possible, is to register and file prior period returns. I'm more inclined to do this if you've collected the tax or there's other circumstances. Maybe it's only been a very recent transaction or a series of transactions, so you're only going back maybe 6 months, and that's the depth of your exposure. That might not be a bad idea, and so we do it on occasion, and there's other reasons why one might go about that. What you're basically doing is, during the registration process, you're acknowledging that you should have been registered, and let's say we're doing the registration today, I should have been registered July 1 of 2023. And once you do that, once you submit that registration, the state system is going to obligate you to file returns from July 1st of 2023 through current. So now you're going to get an assessment. You're going to get your registration. You're going to be able to set up your online account to file the return, but you are going to get notification that you have obligations to file those returns. Some of those notifications come in the form of arbitrary assessments, so it can scare you or startle you a little bit. Some of them just say you have a delinquent return that needs to be filed. Please file it. But anyway, that's an option. The third option, and the one that really designed for companies that really have a significant material exposure in the past, have a fairly lengthy history of having nexus and taxable sales, and maybe they have collected the tax, maybe they haven't, is what we call the voluntary disclosure agreement. Every state has some form of a voluntary disclosure agreement process. We call them VDAs, but they do vary. They are different to some extent from state to state. The basic concepts are that penalties are abated almost systematically. If you have collected tax, there's some states that really frown upon that, so they may give you some small penalty on the taxes you've actually collected. But if you haven't collected any taxes, you'll generally get abatement of the penalties. And then what I believe to be the most benefit of a voluntary disclosure agreement is what we refer to as a limited look-back period. This is where the state looks at your facts and circumstances and says, okay, you had nexus 8 years ago, and throughout the course of the last 8 years, you've consistently had nexus. You've had taxable sales throughout the course of the last 8 years, but you haven't collected any tax. We're going to give you this one-time opportunity to come forward, disclose that circumstance and those facts. You're going to agree to go back 36, maybe 48 months. The states vary in how far back the look-back period is. You're going to disclose those tax liabilities to us as part of this agreement. You're going to pay that tax to us. We're going to impose interest on those taxes, but we are going to waive the penalties. And everything older than 36 or maybe older than 48 months, we're going to forgive that. So long as you're honest with us and you disclose accurately your circumstances, we'll forgive those older periods, and you kind of start the process with a clean slate. So there's a lot of benefit to companies that are in those specific circumstances to go down the voluntary disclosure path. And we do a great deal of work on voluntary disclosures for companies. It happens quite a bit when companies are going through an acquisition, and under due diligence, there's a discovery of risk and exposure, and usually the buyers force companies down the path of a VDA. One point to make about VDAs, they're generally limited to taxpayers who have not been identified by the state. They haven't been notified for any reason associated with that tax type by the state, and they've not been registered historically in that state for that tax type. So those are typically some of the criteria that are required before you qualify to participate in the VDA program.
Jeff, I'm afraid to start speaking here. I just feel like a cough getting ready to come out at any moment, so bear with me here. I will reinforce, though, that first point up here in terms of registration and prospective compliance, where you may have said it, but it's important to recognize that this is not the way the states typically will want you to do it. There's not going to be anything statutorily that says this is the right way to do it.
Valid.
However, we have had, and Jeff specifically, I think you've had some conversations with some DORs that you kind of lay out that picture of, hey, I've got a taxpayer, they want to be compliant, there's no way financially possible that they can come clean and pay these back taxes. So we do advise them to go ahead and get into compliance and just start collecting and remitting from that point forward. And I don't think they've given you the, yes, that's cool, but they kind of give you the head shake, like, yeah, we get it.
Yeah, it's a great point. A sidebar story time, I guess we'll call it. This came about as a result of one of these webinars. We were doing one of these very webinars, and unbeknownst to us, the state of Pennsylvania was on the webinar. At least one, maybe two people. And a few days after the webinar, I get an email from the Assistant Secretary of Revenue of Pennsylvania. And the email just basically says, hey, we were party to your last webinar, and we would like to speak with you. Well, the pucker factor went way up on me in that regard, because who knows what I'm capable of saying that's really out of line on any given conversation I have. So I reluctantly reached out to them and responded, and we set up a webinar, and there was two assistant secretaries of Pennsylvania's Revenue Department on the call, and it couldn't have gone any better. It was a delightful conversation, and they weren't in any way, shape, or form critical of anything that I had said on the call. What they wanted to know was, look, you guys are a big player in the sales and use tax arena. You talk to a lot of companies. You work with a lot of companies. We want to understand what we can do differently, what we can do better to promote voluntary compliance. And so we had a very, very good conversation. And I said to them, I said, you probably heard this on the webinar, but I'm going to reiterate it because I don't want to be afraid to say it in the future. And that is what Brian just described and what I just said. Sometimes the only option you have is to get registered and start complying prospectively, knowing that you had an obligation to comply previous to that date. Now, when I say that, I'm not talking about taxes collected. If you collected $1 in the past, you need to get that dollar remitted. You can't be collecting tax and not remitting it under any circumstance. But it might be you collected $10,000 in the past. You also have another $500,000 you're exposed to in the past. And you're like, what do I do now? Well, you still might opt to register prospectively, and on that first return, just pay in that $10,000 you collected. At least you've remitted what you've collected. That's a very important aspect to compliance. And then you're off and running to voluntarily comply. You're doing, in some ways, the only thing you can do. So anyway, that was a good story. And what I guess the end of the story is kind of important. As I told that story, or as I explained that to the two gentlemen, they both kind of shook their heads up and down, and they're not giving me the rubber stamp to keep talking about this, but they're basically saying, we get it, we understand. And they basically said, if you find yourself or your clients in those predicaments, come talk to us. Let us see what we can work out beyond even the general statutes around the voluntary disclosure programs. So anyway, sorry.
Yeah, no, that's good stuff. So We've got quite a bit of content here that we'll try to get through here in the next 15 or 20 minutes. But, this next piece is really kind of looking at, we've done that nexus analysis, we've determined we have taxable sales, we've maybe identified some level of exposure, and we've decided some kind of path forward. And in parallel to those, in parallel to those discussions and those decisions about, what to do, you need to start kind of thinking about, well, how do I charge sales tax now, prospectively? And there's a lot of different options. There's certainly, software out there, there's manual opportunities, but we'll talk about that here just briefly. Some of this is a little bit of a repeat, but I like to kind of simplify things as much as I can. And when I think about, what do we need to do to charge the right amount of tax, there's really kind of three things typically that we need to know. And again, I'm probably oversimplifying this, but we need to know the situsing location. As Jeff mentioned, at what point does the tax apply? So we need to know that piece. We need to know in that jurisdiction, is the product or service that we're supplying, is it taxable? And if it is taxable, at what rate? And if I've got the answer to those three questions, then I can charge tax pretty effectively. So when I look at it through that lens, I look at the different invoicing systems I might be utilizing, or even shopping carts if I'm an e-commerce provider. And each of those systems is going to have a varying degree of capabilities around determining the taxability and the tax rates to apply. Some of this, in terms of the direction that you go, will also be determined and factored into the type of products or service that you sell. So if you're selling tangible personal property that's taxable everywhere, I don't necessarily need the power and the sophistication of a sales tax software solution to determine the taxability of something that I already know is taxable everywhere. So in a scenario like that, it may be very effective just to, for example, subscribe to a tax rate solution to apply the correct tax rate within my accounting system. On the flip side, if I'm selling something where the taxability is extremely varied from state to state, you've heard us reference software as a service. We certainly do a lot of work in the telecommunications industry, which is probably the most taxed industry, at least in the U.S. It's difficult to operate at all without some type of tax calculation solution. And I'm sure some of you are aware of those, but we have a lot of clients that utilize Avalara, they utilize OneSource from Thomson Reuters, SureTax, Vertex. Those tend to be some of the main players from a tax calculation perspective, and they typically would integrate directly in with the accounting system and calculate the tax in real time. Now, the last piece of this that I've referenced is tax mapping, that if you do go down the path of purchasing and implementing one of those sales tax software solutions, the key value point there, in addition to knowing the tax rate, it's really understanding the taxability rules, as I referenced before. And when you set them up, you've got to do some type of mapping of your product SKUs into the tax codes of those systems. The assumption is that the tax software will know and will keep up to date as those taxing rules change. And as long as we map our SKU into the right tax code within that tax calculation solution, then we're going to get the right tax on the back end of it. Sounds easy. It's easier said than done. When we had the discussion earlier about, is it software as a service? Is it information service? What is it that I'm selling? That can sometimes be the most difficult part of figuring out what to do is what do I do? What is it that I sell? And what category does it fit into? So it's really important to understand, exactly what it is that you do and how it's done, and map it into the correct tax code. Kind of taking this, a little bit further in terms of setting up this process, you're going to have to get registered at some point in these jurisdictions. And we talked about in that comply and register prospectively, or register and comply prospectively scenario, each of these states is going to ask for a start date or an effective date. When did you first have taxable sales? And that's a tricky question. And if you answer it with that register and comply prospectively, again, we're not necessarily doing exactly what the state wants us to do, but it is, as Jeff mentioned, kind of a common practice to utilize a current period effective date. You also have to understand, and the officers of the business need to understand that each state has what's referred to as responsible party laws. And what this is referring to is that individuals within the business, it could be an owner, it could be an officer, it could be somebody that has financial control over the business, they individually can be personally held accountable to the sales tax rules for the business. Even if you're operating in an LLC, that corporate officer has exposure and liability personally if the business is not conducting themselves properly from a sales tax perspective. As such, on these registrations, they're asking for social security numbers, driver's licenses, home addresses. What else do they ask for?
Fingerprints, blood samples. Brian covered it, I think.
Yeah, but it's sometimes uncomfortable for corporate officers or anyone for that matter to give up those social numbers, but it's generally required to get a sales tax registration. And you also have to be aware when you're doing these registrations that you're signing up for the correct tax type. Sounds, again, easier said than done. It's, some states are going to have a sales tax registration with a sales tax form. They might have a use tax registration with a separate use tax return. There could be a seller's use tax, could be another tax type based on how your business is structured. So you just have to make sure you're registering properly. And then overall, in terms of setting up that compliance process, and I'm going to skip through a lot of this just as we're starting to, I think, get a little bit close on time. We've got a little bit more to go here. You got to make sure that you're really considering all aspects of what has to be done. One of the things that I was going to say makes me laugh, but it's also kind of irritating, is we'll have conversations with people and we'll say, oh, well, once we get ready to file a return, that's the easy part. That's all the tough stuff's already happened, and now you just got to file and remit. There's a lot there. There's a lot that goes into that in terms of taking the tax data. Talked with a company this morning, I say smallish company. They have 6 retail stores and an e-commerce site running on different systems. They also give away samples, so they have use tax to accrue. So you've got 3 different data sources, all in different formats, that have to come together to form a single return. So most of the time, businesses aren't dealing with one single data source. They're typically dealing with a lot of different types of data, formats of data coming out of different systems, and you just got to be prepared to have the ability to absorb that data, and map it to the returns as appropriate. We alluded to some of these home rule jurisdictions as well, where you could get into a lot of local level filing. Some of the states have made this a little bit more simple if you don't have a physical presence in their state. So there's some centralized remote seller returns in Alabama and Louisiana. Colorado's kind of moving in this direction, but they're not quite there yet. But if you have a physical presence in some of those jurisdictions, you still have to file a local return. And some of those local returns require a actual paper return with a physical paper check. Seems a little bit behind the times, but I don't know how many thousands of checks and paper returns we send out every month, but you'd be surprised that not all of these jurisdictions accept online filings. You've also just got to be aware of any notices. These are getting posted more and more frequently to a state's e-file website. We have clients that start out with a auto file solution from a software company, and nobody's monitoring these notices. They get posted online, and they don't notice it until it's too late. And now all of a sudden there's a major issue that has to be solved for. So you need to make sure you're looking out for these notices and updating your filing frequency, because a lot of times the notice is going to tell us to shift from a quarterly to a monthly return. I don't know if Jeff and I are going to make it through today. We got 10 more minutes to go.
Tough, bud.
So kind of segueing into, what are some things that you need to be thinking about here in 2024, maybe some new things that we see either coming down the road or have already happened. One of them I referenced in terms of the states that are repealing their transaction count thresholds. I won't go through that list again, but we do see it as more of a trend to look out for and to pay attention to here in 2024. We're also seeing, more states taxing digital goods. It's always a lot easier for legislation to, add to the tax base. So pull items into the tax base that maybe were non-taxable before. So maybe looking at states that didn't previously tax SaaS that are now taxing SaaS. That's way easier for a state to raise revenue than to do an overall sales tax rate increase. One state in particular, we're based here in Georgia, so effective just this month, Georgia has started taxing some of these digital goods. The kind of key factors is that digital good must be permanently accessible, and it must not be a subscription, so it's a single purchase price. So think about like ebooks, ringtones, video games, things of that nature that are now taxable in Georgia. So expect to see more of that in the future. Reference Colorado, this SUTS program that they have, the Sales and Use Tax System. It's gotten better. I think this has been around for a couple of years now. Continues to get better. It's not quite there yet. But what this is intended to do is give taxpayers a centralized mechanism to file all of the home rule jurisdictions in Colorado, which I think there's about 73 of those. So it can be a lot simpler than filing 73 individual tax returns in Colorado. The problem is not every jurisdiction or every home rule city is currently participating in that. I think there's maybe 10-ish that aren't currently participating, but I think a few of those are in the process of coming online. So expect that hopefully to get better. There's also some restrictions on whether you can file use tax in that system or not, and there will be more home rule jurisdictions that allow use tax filing through that SUTS return as well as we go through 2024. And also pay attention to, I reference it here in terms of the expansion of tax types. Again, it's a nice legislative way of increasing revenue without increasing the tax rate. We saw this in Colorado with the retail delivery fee, and that's what I'm referencing by a new tax type. It's just something that really the states kind of make up on the fly. And Minnesota has implemented one of these retail delivery fees. I think New York, I think they've at least presented legislation. I'm not sure if it's active yet or not, but we're seeing more and more states go down this path as well.
Bill, I'll kind of take over here just to finish things up, and we won't spend much time on these last two slides. It's more just to leave you with some interesting tidbits of information. These two items here, I think, these were enacted in 2023, but as you're rolling into 2024, you just taking a minute to look at your billing systems, your tax calculation and determination systems, and just make sure they're in line with the laws. Michigan has changed their law in April of 23 to exempt delivery and installation charges that are separately stated on the invoice. One thing that I always kind of think about when I'm looking at transactions that involve both a taxable component and an exempt component is when the state gives me the opportunity to not tax a component of a bundle or even a component of two separate items that are kind of sold together. I start thinking about unbalanced equations, meaning if I'm going to sell a bookcase that retails for $1,000 and I'm going to charge $100 to install it, and all of a sudden you tell me the installation charge is exempt from tax, why not make the bookcase $100 and the installation charge $1,000? And the reason is, and it's a component of this law, your books and records have to reflect a reasonable cost basis and somewhat of a profit margin that's reasonable. You can't flip-flop the values of products and services in that arena. The second one is just a temporarily reducing of the gross receipts tax rate, which is really the sales tax rate. You know, a variety of the states will use terms like gross receipts, transaction privilege tax, excise tax. They're still sales taxes in the general sense. And so this is the general sales tax state rate that's being reduced from 4.5 to 4.2 until June 30th of 2027. And lastly, this is more for comedic purposes, and there is no political agenda here, but it was just a little bit of irony. We've got California that's enacting legislation to fairly significantly tax firearms, and then we've got the state of Louisiana that's giving some preferential treatment to the same industry. So two things kind of going in opposite directions, and it's not meant to make any political statement. It was just interesting, and just thought it would be a nice end to the conversation today.
I've got a little bit of commentary on that, and Kate, I think you've got a poll that you'll pull up here. What's interesting about that is just how influential the local, I guess, elected officials are in terms of how these sales tax rules apply. And, you know, California with a lot of technology companies exempting SaaS, it's probably not a shocker. But you see that all throughout the country in terms of, you know, local politicians, and rightfully so, kind of, you know, working with their constituents and trying to pass sales tax laws that benefit the local community. It's one of the reasons why I think you and I both believe that there'll never be a full streamlined sales tax across the country, because there's just too many
Special interest.
Too many special interest groups today to make that happen.
With a lot of money.
In all scenarios. So wrapping up here, we did have one question that we didn't get to during the presentation, and that is, and Jeff, I think this will probably be for you. Trying to pull up my contact information here. Oh, missed it. So the question is that this individual sells 90% of what they sell is tax exempt from customers supplying resale certificates. At what point do they start counting transactions and revenue against the economic nexus thresholds, given the fact that they're mostly tax exempt?
Yeah, it really depends on the state. It's a good question, and in some states you've got to count all of those transactions, whether they're wholesale, resale, or exempt or taxable. And in other states, you might only need to count that 10% that's subject to tax. So it does vary by state. I would say most of the states lean towards the gross receipts, meaning 100% of your sales would count towards the threshold. But it is a state-by-state question. And I think we've published something on our website that helps with some of that.
I think we've got an economic nexus guide out there. And when Jeff says most of the states, I think it's the overwhelming majority count gross receipts. I think it's 35 plus out of the, out of the 45.
I'm sure the audience was already going to rush to our website to see if they could get a picture of me to download. But there is some good content on our website that helps, and also with some of the SaaS taxability as well.
Yep. All right. Thank you, everyone. Thanks for bearing with us. I'm glad we made it through, Jeff.
Thank you.
All right.
See you.